All right. Good morning, everybody. Good morning. We are back on the DM with Robert Morillo, broker associate with Compass Florida, license number BK3373543. What's going on, John?
Good morning, everybody. John Sepulveda, Origin Point and MLS 1309244. Good to be here for day 2 of the DM.
Amen. Amen. I'm really excited, man. I feel like we had a great conversation yesterday, and today we're gonna touch on another topic that I think is definitely gonna bring us back to the reference point of 2008 again. Like most of real estate conversations, right? These days, because I think our appraisal process in today's day and age is a result of everything that happened from that market crash, that era. So today we're going to be discussing understanding home appraisals and what we need to know about the home appraisal process. So what do you got? What do you think on that? I know the banks are no longer able to order appraisals themselves, right? Now they've got the is it the AMCs? That's
Yep. Yep.
AMCs, so appraisal management companies,
Companies.
right? That they're essentially the third party middleman that orders or selects who is ordered to do the appraisal, right?
Correct. And they
All
have
right.
when the appraisal gets ordered by the lender, the AMC has a process that they follow, and they sort of assign the appraisals, appraisal requests as they come in, based on geography and other parameters.
Yeah. Okay. So, I mean, essentially, how can we best define an appraisal?
It's a report that provides the lender with assurance of what the home is worth, that the borrower is putting up as guarantee or collateral on their loan.
Yeah, essentially an opinion on price,
Opinion on value.
but yeah, opinion on value. Correct. In which, I mean, an appraisal is a more official opinion. It's not like a broker's price opinion. Um, it's more like the stamp of a value on what the lender is willing to loan against the home, right?
Correct. I mean, and it's a lot, and it's a very different process. When an agent does a CMA, right?
Mm-hmm.
Market analysis on the property, it takes the comps, and in essence does a minimized version of what an appraiser does. The
Mm-hmm.
appraisal is much more in depth as far as the specifics of the property, and the licensing is brutal for an appraisal. It's a lot of like training, and it's a long process. My son's taking the course right now for appraisal, so I'm seeing him kind of firsthand. It's extensive what they have to do. So and it's basically, they take a property, they take the subject property, and then they take 3 other properties at least, so 3 comps,
Mm-hmm.
of the same size and the same condition, and within a 1-mile radius, as the crow flies, is the radius that they utilize to pick the properties. And they looked at the value of properties that is already closed. Under agreement, properties cannot are not counted for value. It is
Yeah, those aren't final yet.
correct. It's only what closed as the crows fly, as they say.
Yeah. So so yeah, typically, like for instance on a CMA, we do about a 2-mile radius for single family homes, 1-mile radius for townhouses, and then half a mile radius for condominiums. So all right, so with the appraisals, how is it working? Like, let's just use Origin Point for instance. Are the appraisals being charged to buyers on the front end, and what is the average cost of an appraisal? with
So
origin point?
yeah, so at origin point specifically, it's 475 for the appraisal. And the appraisal gets charged up front when it's ordered.
And is that regardless of the size of the home? It's just for a 475?
No, if it's a jumbo, appraisals have different set value. They're higher in price. And
Okay.
there's a table that's already followed. Like it's not, they can't just randomly, pick pricing. It's all, that stuff is already set because it all has to get disclosed when the LE gets done. So it's all very, formatted, prior, and everything set prior.
Okay, so
If
when
it's
you
an
say,
extra large property, if it's a rural property, if it's like a beachfront property, like there's certain parameters that make the values more unique, if you would. So like a
Mhm,
beachfront property, obviously that's a little bit different animal. So properties like that have different values to them, different costs to them.
got it. So, okay, so when you say jumbo, you're referring to the size of the loan or the size of the
Correct, or above a
home or both?
non-conventional loan.
Okay, okay,
Non-conventional loan, also known as jumbo loans or non-conforming loans, which means
non-conforming.
they're above the conforming loan amount, 726 Fannie Mae, in this case. So anything above that is called a non-conforming, or a jumbo loan it's what it's best known as.
Okay, interesting. So in some cases, like in a jumbo loan that I've worked on with a client, one, they had to have two appraisals ordered,
Mm-hmm,
right?
mm-hmm.
And two, they actually rebated or reimbursed them on the cost of the appraisal after closing, which I thought was kind of interesting. Do you guys offer that as well?
It's I mean, basically he didn't get, they call it reimbursement. He just got a lender credit.
Oh, okay, okay,
It's
okay.
it's very like, and it's very cut and dry. There's really no, you know, you you got to lend a credit. The lender credit is, it's the, use it for everything. So if you give the lender gives the buyer a lender credit towards closing costs, $1,000. In
Hmm.
essence, rebating the appraisal is the same. It's just it'll appear on the CD as a lender credit.
Gotcha, gotcha. Okay, okay, okay. So, what you call it? All right. So on a standard appraisal, let's just say, a single family home, 2,500 square feet, we're looking at about 475, right? What happens if, like we were talking yesterday about the interest rates, and we spoke very briefly about how there are still multiple offer situations going on for homes under 400,000.
Hmm.
So let's just say in a case where, like, I saw a home down the street here, it was listed for 535,000. This was late last year, and it still went under contract and sold for 585,000. So why don't we discuss, what if you're under contract for well over the asking price and the property does not appraise? What happens after that, and what can be done to rectify that situation?
Well, one of two things happen, right? So if and this is very common, honestly, prior to this madness that we just had through the pandemic in 25 years in the industry, I've never seen really that much of it.
Mhm.
So when they were putting the offers with no contingency, no contingency means nothing on the contract. So no appraisal contingency. If the house didn't appraise, what it didn't appraise, right? And the buyer was aware of that and was put in the
Having to
contract,
come
but they
out
were
different.
aware that the property might not appraise. So what happens in that sense, what lenders do is they lend on appraised value or purchase price, whatever is lower.
Hmm.
So it doesn't matter, if the purchase price is 500 and the appraised value is 400, the lender is going to use 400 as the value of the property. You can still buy the property for 500, but the buyer would have to put the difference in cash.
Yeah.
So if the buyer is doing, this is a absurd example, but let's use it. If maybe the buyer has, I don't know, less than 620 credit score, which is Fannie's minimum, right? So maybe he has no choice but to do an FHA loan. So if a buyer is doing an FHA loan, a little bit less, let's say it's 450. So the math works out because of the loan, the FHA loan limits. So let's say the buyer's doing a purchase price is 450 and the house appraises at 350 and he's doing an FHA loan with 3.5% down. The property, the property appraises, borrower puts 3.5% down. The property doesn't appraise. Let's say it comes in at 350, at 400, right? So 50,000 below value. If the buyer decides to go through with the purchase, he would have to put that 50,000 on top of his 3.5 down payment.
Yeah.
So for the
Absolutely.
essence of the exercise, the value for the loan would be based on 400, and the buyer would put 3.5% of that plus the 50, the difference in 50. So all that cash, that would be cash or money to the table at closing that the buyer would bring. That's in the scenario of if there is a contingency or no appraisal contingency. If there is no contingency and the buyer does the appraisal and the house does not appraise, you can do a rebuttal of the appraisal, and you have to get additional comps that were not used in the original appraisal and provide it to the appraiser and saying, hey, these comps, take a look at these comps, see if they, and usually the listing agent helps with that, and the buyer is the one that's responsible to kind of man that. Like we're not really able to, we can only forward the information back and forth.
So let's talk about that. Let's talk about back in 2008. Since you've been in the business over 25 years, that definitely brings that means you started in 2008, right?
I actually started in 1999.
Oh, I'm sorry.
Real estate, yeah.
Okay. 1999.
No, so I was there for 2 yeah, 08, yeah, I was there.
Okay, because it's 2023. So if you said over 25. My bad. I'm not trying to age you.
No, that's all right. Yeah,
But
I did
You
real estate
started in
I did real
99.
estate for a couple of years before I switched to lending.
Gotcha. So you started lending in 2001.
Correct.
Okay, so you really did see the entire transition before 2008.
Oh yeah, 100%. Yeah.
Okay, so let's go back to that, right? The bank's influence on the appraisal is essentially now non-existent since 2008, right?
Correct. Yeah, and back then so in 2008 I owned my own company. So I was originating, but I was not, an LO. I was a broker.
Okay.
So, but in essence, it was the same process. If you work for a bank, if you work for a broker, if you owned it was the same. You have relationship with appraisers, just like you have relationship with title companies or closing attorneys. I was in Massachusetts, so back there it's really closing attorneys and not title companies. And you picked your appraisals. They were really busy. When obviously it was busy, it was really, really busy. And you had a relationship with your appraisers. I personally had like 2 appraisers that I used. Always used them. They were good. Always used them. I never had any issues
How much
with anything. So, but I know plenty of people who did. I mean, I never, house didn't appraise. But there was, I need this thing to appraise. I mean, and the appraisers were okay. And they came up with these crazy values, which, helped this crisis in 08, fueled that crisis. It was definitely the wild, wild west. I mean, there's no question about it. It was definitely the wild, wild west back then.
Yeah. So what kind of impact did everything that transpired have on your business? And what brought you, like, after that, what brought you down to Florida from Massachusetts?
What impact did it have on my business? Oh, my business closed down, failed, bankrupt. It went under really, really bad. The issue for me was I had no idea how bad it was going to be. Obviously nobody did, right? Just how bad, it was going to be. But, when there was a day, Black Friday, I was like, back then it was obviously faxes and, the things were a little bit different back then, right? Not as technology. So I remember we had on Black Friday, I had like a 4.5 million pipeline for that month. And just one day, just that Friday, faxes just started coming through, loan such from such lender is, effective immediately has been terminated. They just stopped. There was people, it didn't happen to me. There's people I know that were at the closing table. And when the banks closed that Friday, like that day. So the wire never came. They were at the closing table and were not able to close. They lost their deposit. because
Damn.
they didn't perform and the seller kept the deposit. It's crazy. I mean, it was crazy. It was insane. The stuff that, it's just the people that got affected and how they got hurt and affected was, and people didn't understand because they were like, well, what do you mean? My loan was approved. Here's my approval letter at the closing table.
At the closing table. That's insane.
Yeah.
So did you get any statistic or any numbers of like your firm, your company, how many of those loans may have defaulted, or when you closed down shop, you just let it be and moved on?
I don't have the data of like I don't have the data. I didn't get the data. Once I shut down, I moved overseas for a couple of years, so I didn't really have that data, or I didn't pursue it either, to be honest with you. I was very, I like to sleep at night. You know what I mean?
So you were conscious about the business,
Yeah,
how you were operating.
I like to, I like to sleep at night, and I don't, I'm very honest with people and upfront. So I didn't have any issues. I didn't put any people that were, making $4 an hour into a stated income loan. You know what I mean? I didn't do that. So there was a few lenders that actually got, the buyers sued them, and, they had to go to litigation, and all these, crazy things happen. I never had that happen to me, thankfully. And then to my knowledge, nobody that I like know of
Process.
that like went and was overwhelmed by the situation and had to do that. There was people that, like everybody else, everybody was turning the house in, and I'm going to do the same thing, and it sort of became what everybody else was doing. That certainly happened, but that because they were in a bad place, and I put them in a bad place because with a loan that they couldn't pay. I didn't go that route, so I didn't have that many issues. But there's a lot of people I know that definitely had issues.
And what opportunities did you see from that whole dynamic? You said you moved overseas. Like, was that what was that? Was that something
That
you
was
and your
just
wife?
no, it's just life and timing the way it happened. I left the industry not to be back.
Uh-huh, uh-huh.
I was so like sick of it and disgusted by it. I really was. I wanted no part of it.
Mhm.
Because just what happened and the way it happened, it was just ugly. So I mean, because it was, I mean, it was awful. There was people that, and I lived this stuff, right? Like there was people that they'd come into my office. I'd do a pre-approval for them. They could not qualify, for an FHA loan, full doc. They didn't make enough money, the rates, whatever. They just didn't qualify. DTI was too high. And that's when they had the stated income. So the stated income loans were, remember, we're in Boston, right? Mass. So a lot of multifamilies. So what they call here triplex and quadruplex and duplex, so
Yeah, yeah, yeah.
2, 3, and 4 families. Back then, pretty much all the lenders that had the stated income, there were 1 and 2 families. I
Mhm.
was one of 2 brokers in New England that had a 1 to 4 family with no money down. So,
Mm.
you know what I mean? I was one of 2. Lucky, and there was a guy in Rhode Island and myself. We're the only 2 in New England that had that program. So I,
Mhm.
did a lot of business. And but some of these programs we're doing is just, I mean, they were just taking people who clearly did not qualify, and they didn't care. They stated the income. A janitor was a sanitation engineer, and they put, 10,000 a month in income, and the lenders, oh, great. And they approved loans. I mean, it was insanity what happened.
So
So
with those deals, how like the appraisals on those deals, how was it going down? Just like a
honestly,
single family loan? Was it income?
I never had an issue where like I had to say, hey, I mean, you need, this got to go up 10,000. Like I honestly never had. I didn't go that road. That's not sort of how I operated. So I never had that issue. The
Mhm.
properties for the most part were appraising. They really, I mean, they were coming in add value for the most part.
Yeah.
I was in the city. So it's obviously, the city is more expensive, and so it really wasn't, too like I didn't really have the issue of, oh my God, house is not appraising. That wasn't it. It was more with the Wild Wild West. So somebody would go in for they come into me for pre-approval. They don't qualify FHA. They have to go stated. That's the only option they have. They would go to a regular bank, regular banks, like not even like broker companies, like reputable banks. And what the lenders would do with the LOs, because back then there was no licensing, it was the Wild West. And what they would do is they would do give a pre-qualification to a buyer for an FHA loan. And the buyers would apply for an FHA loan. So back then the rates were 6.5%, 7%, somewhere. I don't remember where, somewhere in that
Get
neighborhood.
out of here. Don't tell me that.
Yeah.
In a day and age where everybody's crying over that rate.
Yeah, that's what the rates were. So it was those were the FHA, like regular like FHA rates, right?
Yeah.
Full doc rates. And so what they would do is they give the buyers pre-qualifications for an FHA loan. This happens, a lot more in the Hispanic community. Because obviously people didn't really speak English, and the buyers didn't, so that happened a lot. So they get to the closing table thinking that they were going to close on the loans approved. They get to the closing, they think they're going to close on a loan that was an FHA loan at 7%. And they get to the closing table and they get the surprise, your income's not enough to qualify for FHA. We had to do this loan, stated income because you didn't have enough income, and it's, and I want to say the first mortgage was on a 228 or 327s, which means fixed for 2 years and then it becomes variable, or fixed for 3 years and it becomes variable. Those were the popular ones with the stated income. The first mortgage was like mid-8s. And in Massachusetts, the second mortgage, the cap was either 12.99 or 13.99. I don't remember what the max was. So that's what the second mortgages were at. Lenders, we didn't really get paid on the second mortgages because there was no, there was just no room to get paid. So it was really everything you just got paid on the first mortgage, on the 80%. And the way that worked was tied to to an index. And it was like, prime plus like 6 or some crazy number like that. So when the rates adjusted after 2 years, month 25, the rates went from like 8.5 to like, 14%, like insane, just with the adjustment on the index for the arm. So that's what happened. People overnight, their payments went from 8 to 14 overnight. I mean, that's a big difference. One point is the exercise we did yesterday, 1% was like $257 a month. Imagine going from 8 to 14, the difference in it, just the balloon, like the amount of payment, and people were like, well, that's what kind of triggered it. It was the adjustment, because what the lenders told people at the closing table, oh, don't worry about it. This is fixed for 2 years. You're going to be fine. And then you can refi. And you'll have enough money. And the same story that they tell people. And so people are like, okay, I'll wait for 2 years. And then prices, the market started slowing down and the properties were not appraising. That's when the appraisal issue started happening, was when the market kind of crashed, because the market kind of died. And there were people trying to get out of deals that they were, upside down, basically. And the market just started going, dropping. And then people were upside down. They could not refi because they needed to bring cash to closing to be able to pay on the first mortgage. People didn't have that. So that's when people started walking away from. Some people couldn't afford it. They truly couldn't afford it. And then the other people were like, well, wait a minute, my cousin's not paying money and their house is undervalued. I'm not going to keep on paying money. And people just kind of stopped paying money. And it just became like a plague, and everybody just started doing that.
It's so insane because I can't even fathom like the thought process of that happening again. Like the process just got so strict after that there's no way, and the demand is so strong, there's no way it can happen again.
No, yeah, because just right now, the underwriting, the way they changed the guidelines, it just changed. Yeah, I mean, it was the Wild West. I mean, compensation, loan officers were, that's just the way they got paid. It was insane. It was crazy. You got points on the front and the back and yield spread and all kinds of crazy things. And it was the wild West. I mean, it really, really was something that needed to be, contained. And, luckily they did. Yeah, they might have, over time a little bit and, made it. But at the end of the day, it's better for the consumer, and it's, it helps people. They put so many rules to protect the consumer that it's actually a problem sometimes for the consumer,
Yeah, it
There's so
because
many
it
rules that they
becomes an
put.
obstacle, right?
It's a big, so some people, it just becomes an obstacle, but it's better to have that obstacle and here and there than to have massive, losses like we had in '08.
Mhm. So, all right. So maybe this might be like the last question. But knowing what you know now, then if you were to go back and do, have an opportunity to do things over, would you do anything different to keep your business alive? And if so, what would that be? What would that have been?
I would have the biggest difference in me personally now and then was I was younger, obviously. I was not in tune to the market
Hmm.
as I am now.
So would you say that experience caused you to become a student to the market?
Uh, that's part of it. But that's part of it for sure. And real. I'm trying to figure out. Okay, what do I need to? What do I need to? So I've always done when I work with buyers. I've always done the financial coaching aspect of it, right?
Mhm.
Helping people fix their credit, and here's what you need to do, and do this and do that. And I learned how to do that, right? So you kind of learn, and I
Yeah.
always did it as needed. So now with the pandemic, when the market, the things change, you have to reinvent yourself, right? If you don't change and you're going to adjust, then you're going to be extinct. So I felt that I needed to sort of adjust the model, how I was going to work, and then I got into I'm a numbers guy, I'm a data guy, so it's easy for me to see a chart and understand it, and that's just the way I operate. So I started getting into it, and I started learning about it. And then it's just sort of, I mean, it takes a lot of work. It's hard to do because it's hard to keep up. And if you don't keep up with it, I went on a cruise 3 weeks ago, or 3 weeks
Mhm.
ago. Um, and I put the internet package, I bought it. I wasn't going to do it because I went on vacation, but
Yeah.
I could not. I felt that if I was disconnected for that whole week,
Yeah.
I would have just been, you know what I mean? I would have had to come back and I would have been buried trying to catch up with get the old news before I can get the new news. You know what I mean? So I was like,
Yeah.
I got the package so I could keep up with the news, and I kept up with the stuff. So because if you don't keep up with it daily, it's a mess because things happen so much. I mean, yesterday we're talking about the status of the market and what's going on, and I mean, the market was kind of crazy yesterday. I mean, after we finished the call yesterday, the futures in the morning, the stock market was going to tank. I mean, it was because of Credit Suisse, what was happening in Europe,
Mhm.
and the market changed, the market rallied, the market went up, mortgage-backed securities, they went down. 10-year bond started going up. At the beginning in the morning, it was like at 329.
Mhm.
We were 4 not too long ago. So I mean, that dropped like the yield curve got inverted. We talked about yesterday about that it was inverted. It went back to normal for a little bit. The
Oh
2-year
man.
was lower than the 30-year because the 30-year went down to 3.29, right? So briefly it happened, but then
Mhm.
the market rallied, and the cause of the rally is people feel that the Fed is going to pause and not do a rate hike. At the beginning they were concerned, Credit Suisse, they got bought out. That's still shaky. I mean, the thing was worth $8 billion last week, and they bought it on Sunday for $3 billion. A lot of people lost a lot of money. A lot of investors lost a lot of money. They didn't
Mhm.
do what they did here with Signature and Silicon Valley. You
Yeah.
know, the Swiss, the country, they were like, okay, you're on your own. See you later.
They
They
just
got
sold
another investor and they sold it. And that's
sold
going to have,
below market value.
well, not only that, they raised rates in Europe by 50 bips last week.
Mm.
Knowing that stuff was happening, they didn't care. They raised 50 bips. So now that's
What is BIPS compared to percentage? Like what is
basis points. That's what everything in the lending
oh
is
BIP.
basis
Okay,
points. Yeah,
okay, okay,
bips,
okay.
BPS,
Gotcha.
basis points. Yeah,
Okay,
sorry.
okay. It's like
Sorry.
it's like RBIs. If you don't know baseball, you don't know what an
You don't know what that is.
RBI.
Um, so that they raised 50 points, right? So what we're talking about yesterday is that this week is crucial because the Fed is between a rock and a hard place. And yesterday's data, I mean, Credit Suisse, that's still messy, so the expectation, people are expecting the Fed to pause, not to raise. The market that yesterday, I haven't checked, I didn't check at the end of the day, like at midday, a little bit after midday, it was like 74%, chance that he was going to raise Feds by quarter.
Mhm.
So people, that's, but there's anxiety over that. Is he going to raise? Is he going to hold? But if he raises, and banks are going to, get nervous because they're going to continue the struggles are going to continue. In Pacific, that bank is, it's on the edge. It's they told you they deposited 30 billion from 11 other banks, and they're still going. Stocks are going down that bank. So something, anything could make it, because it's on very, very, very shaky ground right now.
Yeah,
So
I
if
was
the
thinking
Fed,
about that when you were talking about it, was the fact that they took that large loan, short-term loan, right? 120 days. I would imagine everybody out of a panic is going to want to pull their money out before that 120 days is up. So then if they have to return that money, what then?
right. I mean, that's the thing, right? Nobody knows what's going to happen in 120 days, but more than if the market continues to, and people feel nervous, they did that to kind of say, hey, don't run to the bank, hold off. But if, it's just the value, it's losing value. People don't have any, confidence. Things got no money, so it needs more money. They're trying to figure out, they're still looking for a buyer. They're trying to figure something out.
Yeah.
And so if the Fed raises the rates, it's going to put more pressure on the banks, and there's very fragile. So something could give. If he does not raise, if he holds, we still have an inflation problem. And we have an inflation problem because he's reading the data from the past, right? He's driving, looking at the rearview mirror. So next month, when in the CPI report next month, the data from a year ago, it's not very, there's not a lot of room to move. So the next month's report, it's gonna, it may or may not do anything to inflation. Like, it may show it's the same, it might drop it a little bit because the numbers from a year ago are still in the lagging indicator, which is housing. As I explained yesterday, that card hasn't made it to the front. So next month's report, the April report, it's not going to be that good to show that inflation is really going down, as the exercise we did yesterday with that, with the housing component. If we take that out and use the real number, right? That exercise we did, which is 2% lower, that would be, so that's going to come up, that will come up on the May report. So on the May 10th report, then you'll see there'll be a big fluctuation in numbers on the positive for those of us that are looking for inflation to be down, right?
Yeah.
So that's when that May 10th is going to come, and then there'll be data to say, okay, yeah, inflation is going down. It's at whatever, 3.5%, 3.5%, whatever it is, right? Hopefully that's what we get to. The problem is that now if now they got to print money again for the bailout of these banks. So the Fed's, the balance sheet, they've been taking money out of the balance sheet, right? They've been taking money off circulation, but now they have to print again. So that balance sheet is going to grow again, and it's going to start, it's just going to grow again. So that's the predicament. And, we'll see what he decides to do. I mean, from the knowledge I have since I started kind of following this, I feel that, you can't fix stupid. I mean, you can't fix it, so
Stupid is what stupid does, right?
It's going to be painful. I mean, there's so many people saying, looking at the data and saying, look at the numbers, look at the data. I mean, there's just so much data pointing to this, like, you got to hold on. And he's plowing right through this thing. So we'll see. It's going to be, today's going to be, it starts today and it's tomorrow, and we'll see what the outcome is.
When you say he, right?
Jerome Powell, the Fed, the chairman of the Fed.
Huh? Okay.
Jerome Powell, the Fed.
Okay.
Yeah, the chairman of the Fed. He's the one that he's flying the plane. So it says, what I mean? There's a board that votes, but the Fed is the one that,
the ship.
Yeah, he's the commander. So he's the one that's making the decisions.
Yeah.
The problem is that and this is another underlying problem with Credit Suisse is the Secretary of the Treasury, testified in Congress, and she was asked, if another bank fails, and I think it was a gentleman from Oklahoma, if another bank fails in Oklahoma, their deposit safe, like it was at Silicon Valley, and she No. The majority of the Fed, the Fed board, the super majority of the Fed board, she and the White House have to agree what banks they bail out. Pretty
Mm,
much, verbatim is what she said.
yeah.
So she basically said, we, the board, the
Mhm.
White House, and her will pick the banks. So it's not every bank, it's just the ones that they pick to save.
So it sounds like it's gonna be a lotto pick, a lotto system.
Many, many all. Actually,
Yeah,
not
yeah, yeah,
lotto. It's really
exactly.
because they're the ones that pick. So it's who they decide to, to pick. Will they save? So that makes people nervous, right? Because
Mhm,
then
mhm.
what happens is, if you have your money in a small bank, a smaller bank, you might get nervous. Okay, wait a minute, this is not going to get bailed out. This is not going to be secured. Let me take my money out of this bank and go to one of the big four, because those will get bailed out. So that'll
Mhm.
hurt the small banks though. And what happens is the ones that do a lot of the lending and keep the economy are the smaller banks. Business loans, you know what I mean? The small banks really help the economy. So you take those out, and you
So,
take
so
money out, you take more money out of the system.
speaking on this, right? The influence that the banks, or not the banks, the lenders used to have on appraisals, right? Is there any influence at all as to like, all right, if the economy is shifting the way it is now, the way money is moving now, are we seeing an influx in property appraisals coming in lower, or like how does the state of the economy impact the appraisal results, if at all, anymore?
I mean, I think if, you know, things happen that are not, that are shady, I'm not aware of. I haven't seen it, you know what I mean? So I don't, but what I've seen is it just the properties of the value of the property they sell, and they're not selling for that. It doesn't matter that a household, last year for 150,000 over asking, today
Yeah.
it's not worth that. And because the 5 comms and the 1 mile radius or the 2 mile radius are, 100,000 less, and that's the value. That's
The craziest thing I saw over the pandemic, there was one buyer that I worked with, I want to say late summer of 2020. Was it 2020? No. Late summer of 2021. The craziest appraisal result that I saw was that, and this was totally unexpected, a property came in $100,000 under asking price, under contract price. That was the craziest
100 grand.
thing I saw.
Wow.
100 grand under. And this is like at a time where everything was selling over asking price. It was absolutely insane. I couldn't believe it. I couldn't believe it.
Hopefully you're not the listing agent.
No. I was the buyer's agent.
Because that listing agent missed it by a lot. I'm gonna
Boy,
say. I'm
boy,
gonna.
oh boy, I couldn't
Yeah,
believe
yeah.
it.
That's a big miss.
So, all right. Anyways, I guess we will pick up on things tomorrow. Definitely appreciate your insight and background. I'm glad you definitely. I was still a student in high school, or I was coming out of high school when the whole 2008
Stop
situation was.
bragging about you're younger than
But
me,
I was,
man. Come on.
but no. I was observant of what was happening, and actually my godfather, he was in real estate too. Um, I mean, he was essentially didn't keep himself in the business either after that whole era. So by the time 2012, 2013 wrapped around, he was out of the game
Hmm. Yeah,
essentially.
it
So
was it was ugly. I mean, it was so ugly that I love. I'm like, I'm never coming. This is terrible. I'm not dealing with this again.
what
And
brought
then I
you
came
back?
back. When I came back,
Last
and
last question. What brought you back?
when I came back from overseas, I ran into an old friend of mine who used to work with me. We were really good friends, and he stayed. He didn't leave the business. He stayed in the business, and he was VP of sales at a credit union.
Uh-huh.
And he didn't do too much FHA, and I did a lot. I've done a lot of FHA, first time home buyers, the market,
The
kind
coaching,
of,
yeah.
yeah. So he needed, his LOs were not strong at FHA. And he's like, hey, I need
Mm.
you to, come in, do some training for these guys. And, Are you crazy? It's like, come on, I'll pay you. Like, and he paid me like as a consultant to go in and do like some training. And then when I went back and I saw that the kind of rules had changed, and the bug hit me again. I got the fever, and I came home and I told my wife, like, I might be going back to mortgage. She's like, what? I'm like, yeah, and here I am.
Nice,
That's
nice,
how it
nice.
happened.
I like that story.
Yeah.
That's a good story.
You can check out anytime, but you can never leave,
Right, right,
as the song says.
right.
So it's a big week today. Nothing much as far as economic news. Existing home sales come out today,
Mhm.
so that'll give us a number on what the home sales, what's under agreement, in the country. So that'll give us a number.
Well,
Yeah.
let's take a quick look at I'm gonna pull up what's happening here in Orange County, for instance, real quick before we sign off. But essentially, for Orange County, thanks to my handy dandy market watch on the Compass platform, we have just in the last 24 hours, 40 new listings hit the market, 67 total listings active, 26 back on the market. 10 properties have actually increased in price, and 41 of them have actually dropped in price. 57 pending, 28 sold. And this is just within the last 24 hours.
So
Six have
how many total in the market?
active, 67. And this is
Minus the how many pending? 28 pending. So it's
28.
41. And how many
No, no,
sold?
no. 28 sold, 57 pending.
But the pending are part of the active.
No, no. Pending is part of they're the ones that are under contract.
So they don't, oh, active is only not under contract.
Correct.
Okay, got it. All right, well, and what we talked about yesterday, I mean, there's the numbers, like there's not a lot of houses on the market. For
That's not.
March, that's just not a lot of houses on the market. There's way a lot more people that need them. So
Mhm.
that is it's going to get tighter, and as rates, they start creeping down a little bit, that's gonna push the people on the sideline. So before that happens, we're the data shows that we're right before we hit bottom, before they start, things change and the rates start and that's when you get in the market. If you get in the market after you hit bottom, then you're not gonna pay as low as possible. So it's a good time to buy. You go out. If you're on the fence, do it. It's a good time to buy a house.
I think it's always a good time to buy, even when it's not.
And absolutely, but there's certain times that are better than others. You know what I mean? If you hit it right,
Well, you know what I will say is that even when properties were going under contract at way over asking price, and there was multiple offers perceivably on every opportunity out there were still opportunities where people could have bought a piece of real estate or bought a home that maybe was not in the most desirable area or not in the most desirable condition. It's just, hey, people who are thinking about it emotionally are not going to make a move.
correct. And you
So,
can't look at this emotionally. You have to got to look at the numbers. I mean, it's an emotion because it's your home, and you're going to live there, and the white picket fence, and the American dream, and all the stuff. And that's a phenomenal thing. But at the same time, a real estate property is the largest investment most people make in their lifetimes. And
mhm,
most people do not make an investment that's over $300,000. They just don't, right? So real estate is that, but people don't treat it as such. They just treat it as the house where they live.
correct.
And it's emotion. It's a lot of emotion. And sometimes you have to, it's, like I have conversations with, with couples, right? And, the one of the parties wants, the huge kitchen and the brand new bathrooms and this and that. But then that house is, $100,000 over what they really should be buying. So it's
Mhm,
like, well, buy the smaller one, build your nest egg, get ready, learn how to do it, process, and then move up, down. Like, don't, let's crawl before we run. But people want to just go, buy a house, and they want to run the sprint. They want to go buy the $1 million home on the first way out. And it's back in the day, people used to buy a townhouse or a small condo.
mhm.
If they bought a really small condo, maybe they move up to a townhouse. right? And they'll buy to a, you know, up north, they bought a 3-family house. They got some
Mhm.
rents, and then they went to a 2-family house, and then they went to a single family, and then now, you know, that's how they did it in the old days.
Yeah,
And that should still be so today. I mean, the market is
that's
set up for you to do that. A person right now, you can take a person and they can go buy a house, a condo or a townhouse with 3% down,
mhm.
and they can live in that house for a year, you know, get their feet
Their
wet,
feet
get
wet.
on the ground, learn how to do it, and then they can go buy they can go with an FHA loan and buy a triplex or a duplex
Mhm.
from the condo or the townhouse with 3.5% down. They already own a house. They don't need to be a
Utilize
first time home.
utilize the projected income as part of their qualifying.
100%. And they can totally legally, ethically do it. Buy with 3% the small house, get better, build yourself up, build your family, and go buy a triplex or a duplex. Live
Yeah,
in one, leave the condo rented. That you can do that with 3.5%. Leave the condo rented with 3%. Go buy FHA with 3.5. Live in one unit, rent the other two, or rent one and live one. Build yourself up, get in, you know, get your savings, get settled, get straight. Go buy a single family with 5% down.
mhm.
So if you bought a duplex and the condo or townhouse and the single, now you have 4 units.